Hello, this is David of Bionic Turtle. Welcome to the first video for the series of videos devoted to part 2 of the Financial Risk Manager. And so we start with topic 5. Part 2 candidates are responsible for topics 5, 6, 7, 8, and 9. And so topic 5 is devoted to market risk. And this video is 5A, and that's to denote that it's the first of 5 videos. So we actually have 5A, 5B, 5C, 5D, and 5E. This will publish on March 9th, but we have several methods or means to access the video with a stream or with a download. And also don't forget, you can get the PowerPoint slides directly downloaded in the PDF format. All of it unprotected. And so we start with the sequence of the study guide and 2 chapters which repeat from prior years from John Hall. Chapter numbers have been updated slightly because he's added some chapters, although the content of volatility, smiles, and exotic options is pretty much identical to the last 2 editions of John Hall. So we start with the volatility smile, and the first thing about it I would say is that we're dealing with not historical volatility, but implied volatility. So the volatility smile is going to be a plot of implied volatility on the y-axis against, we have a few choices here, but our basic choice is going to be a strike price on the x-axis. So depending on the in or out of moneyness of the option, implied volatility, the volatility smile refers to the fact that we observe an implied volatility that is not constant as the moneyness of the option changes. The volatility term structure gets a brief mention here. The only difference is it's going to be implied volatility but plotted over, in this case, the x-axis, so that variable is going to be time of maturity. And really, Hull has less things to say definitively about the volatility term structure, except that we can combine them into a 3-dimensional volatility surface. And so, for example, this is an old implied volatility that I had calculated based on actual Google stock options, where we can see the volatility skew in action. And so that volatility smile refers to the generic fact that it's not constant. And then Hall would say in equities, we tend to experience or observe the skew, just we tend to, because this is all empirical, and that volatility skew in the case of equities refers to the fact that we historically have experienced or observed higher volatilities over here on the left side where the strike price is low, and diminishing down with lower implied volatilities where the strike price is high. So you can see mine here is basically consistent with Hall's stylized volatility skew in the sense that it's high over here and then decreasing as the strike price increases. And then mine goes up again with some smile-like characteristics, but his skew point is really that higher implied volatility here, lower here, and maybe continuing to go low here, maybe bending back up. But because it's implied volatility, which is to say it's the volatility that we would input into the option pricing model, like a Black-Scholes, in order to compute a price that matches the observed market traded price. So implied volatility is reverse engineered from the observed traded price. We require traded price on the option. So it's really just empirically observed, and so it could change over time. There's nothing magical about the contour shape of this implied volatility. But there are some economic theories behind some of it. But just notice in particular, an important feature is that we are going to expect the calls and puts with identical features to have identical implied volatility. So over here on the left, at low strike price, we really have, as we go over here to the left, deeply in the money calls corresponding to deeply out of the money puts. And over here on the right, we have out of the money call, in the money put. And then we're going to see that a theory here is crashophobia. It really refers to the left-hand side here on the theory that deeply out of the money puts are going to be more expensive, have higher implied volatility because there's some built-in fear around a crash. Hull then chose some basic put call parity type math where we've got the formula for a Black-Scholes here. We've seen this before in part 1. This really is put call parity applied to the model. We've got the call value of the call plus discounted cash is equal to a protective put plus the underlying share. But that's in terms of the model. Put call parity is also going to hold up in terms of the market prices. So once again we have this distinction between a model price and a market price. This call market price, that's the one we would observe traded in the market. We wouldn't necessarily expect it to match the model price for several reasons, including the model doesn't include technical factors. But then if we do a subtraction here, Hull's point is that the dollar pricing error when the Black-Scholes model is used to price a European put option should be exactly the same as the dollar pricing error when it is used to price a European call option with the same strike and time to maturity. Okay, so really, this is the key point of the chapter, I would say. And that is Hull reaches back to an earlier chapter on the development of the Black-Scholes option pricing model. And you'll recall, like a lot of our models, it's based on a set of really ultimately restrictive assumptions, including constant volatility in the log normal price process. The continuously compounded returns are normal, meaning the price levels are log normal. So that's an assumption of the Black-Scholes option pricing model. Hull's basic point here is that if in fact the stock price, that's the underlying asset, if it did behave according to that assumption, if it exhibited the log normal property, then what would we expect from the volatility smile? Well, what we would expect is a flat line, which is to say, if the stock underlying asset behaved according to the assumptions, then we would expect implied volatility to be the same regardless of the strike price. That's consistent with that assumption of a constant volatility. So the fact that we observe a volatility smile, or really a non-flat volatility plot, implies the point that Hull makes is what we should infer from that is that the underlying stock price behavior is not log normal. So that's really it. The volatility smile is evidence of the fact that there is a violation in the underlying assumption of a log normal property. And then for the exam purposes, the way this tends to play out for our purposes is really it's a matter of do we have a high or low implied volatility? So if we look at a plot like this, where it's inverted, so this is the opposite of the smile we looked at before. On the left and right, we have low implied volatilities. And now this would correspond to an asset price distribution with light or thin or non-heavy tails. And over here, we have that high implied volatility on the right, so that implies that the distribution has a heavy right tail. Low implied volatility here implies that the distribution has a light left tail. Okay, just two more examples. Here's our typical smile or skew for equities. What do we infer from that? Well, that the left tail is heavier than log normal, and the right tail may be lighter than log normal. And here, if there may be jumps, then that would imply unconditionally heavy left tail, heavy right tail. So that's really it. We just want to look at if this is high, heavy, if this is low, light tail. So the two conditions for the log normal asset price distribution, going back to that Black-Scholes assumption and the underlying Wiener process, are constant asset volatility and a smooth or diffusion process. That Black-Scholes-Merton, that Wiener process, is a smoother diffusion process, meaning it has no jumps. However, Hull says that neither will be satisfied in the case of an exchange rate because the volatility of the exchange rate is non-constant and it exhibits frequent jumps. What are possible explanations for the volatility smile? So this gets into some sort of economic rationale for why we might observe a non-flat implied volatility. One would be capital structure leverage. So here the theory is that as the company's equity value decreases, the leverage increases, and that contributes to higher volatility. And again, this crashophobia, this theory that deep out of the money puts are necessarily priced with a higher implied volatility. We have a couple of different alternative ways of characterizing the volatility smile. So again, we're going to have on the y-axis here implied volatility, and the x-axis. Our typical is strike, but we can use a ratio of strike to forward price. And in that case, the at the money is going to be when the strike price is equal to the forward price. And we can also use the option delta. So that's one of our Greeks there. That's maybe our most popular option Greek. We can use delta on the x-axis, where at the money is going to be a call delta of 0.5, or for a put delta, remember those put deltas are always negative, between 0 and -1. And so that'd be negative 0.5, and those would be called 50 delta options. We have, again, the volatility term structure, which can be combined with the volatility smile to create a volatility surface. And the fact that the Greeks complicate the volatility smile, it's actually been sort of softened, almost removed from the latest chapter. This concept itself, extremely low testability. And then the impact of asset price jumps on volatility smiles. So where a large jump, either up or down, is anticipated, the actual distribution is log normal, but may be bimodal, so you may have two humps. Now, unconditionally, this can manifest as heavy tails. Chapter 25 is exotic options. And so we start with the distinction between plain vanilla call or put options. So those are standardized as opposed to over-the-counter and tend to trade actively. And so exotics are going to generally be any non-standard options and therefore not well suited to trading on an exchange. And they serve to meet a specific need to tailor the hedge, or maybe to take advantage of accounting, tax, or regulatory motivations. So factors that drive the development of exotic products including hedging need, tax, accounting, legal, or regulatory motive, to reflect a view on a market variable, like to place a bet or express a view on volatility, and more cynically, Hull says, occasionally to make a new product to sell. He also says that any derivative can be converted into a zero-cost product by deferring payment until maturity. And a package is a portfolio of standard calls and puts. It is easy to create a package with an initial cost of 0. A standard American option has a fixed exercise price and can be exercised at any time. So the non-standard options make exceptions to that. So they restrict the exercise either to certain dates, or in the case of an employee stock option, they don't allow for exercise in some initial period, say 1 to 4 years. Or an index stock option would be an example of a non-standard option because the index, the strike price is changing over time, maybe indexed to the S&P 500. So the heart of this chapter is describing some of these various exotic instruments or exotic options that Hull reviews. And I've updated the my diagrams. I hope I made them a little more modern this year. We've got the forward start option, which really hasn't appeared in the FRM so far to my knowledge. And this is just an option where Hull's example is actually an employee stock option or executive stock option where the company makes a promise to grant the option at the future date. So here we are at time 0, and there's a promise to grant or sell that option at a future date. So really at the future date time 1, then it's like a new call option. It's the only difference here. At the forward start option, it's just a deferred option. And the key insight here is that just because of the discounting, if C, that's our notation for the value of a call option, in this case we have a European call option. If C is the value of a European call option that is granted with a term to maturity or maturity of T2 minus T1, if we price the option with that maturity here and give it a value of C, and then discount really with the dividend, then the value of our forward start option is just the value of C discounted by the dividend. In the case of a non-dividend stock, so that means we get this sort of self-confirming outcome that the value of a forward start option is going to be equal to C today. In other words, we can price it just like an option today, as long as we're careful to use the maturity here between T2 minus T1, because after all, that's when the option will be granted. And the idea here is that it's under the assumption that the stock price is going to grow, but as a percentage, the value of that call is constant. So it's going to be a little higher here, but constant in percentage terms, as we discount back today, we're going to end up with the same value C. So a compound option is an option on an option. That means that a compound option has 2 strike prices and 2 exercise dates. So here's the first exercise date, and here's the second exercise date. Here's the first strike price, and here's the second strike price. So that means we have 4 permutations here. So here's a set. We can have a call on a call or a put. So that means we can have a call on a call or a call on a put. And we can also have a put on a call or a put on a put. So in the case of a call on a call, so let's say we purchase a call on a call. That means we get to the first exercise date here, K1, or I'm sorry, the time is T1 and the first strike price is K1. So with the call on a call, that means here at time 1, we have the option to buy a call for a strike price of K1. So see how what we really have here with a call on a call, it's just like an option here, except that what are we buying? Instead of the underlying stock, we're buying the option. So we exercise our right but not our obligation for the price of K1 to purchase a call option. So that would mean at time 1, then here we now own the call option, and we get to time 2, and now we're just like in the usual case of a call option. At time 2, we can then exercise the call by paying the strike of 2, and then we'll own for that price the underlying asset. So we've got a call on a call. We first had the option, but not the right, but not the obligation to pay K1 in order to purchase an option, and then we hold the option, and then we subsequently at time 2 have the right, but not the obligation to purchase the underlying stock. So that's call on a call, and we can similarly have 4 permutations. With the chooser option, the idea here is that at time 0, we purchase the chooser option, and then at time 1, we have the right to choose whether it is a call or a put. So the value of the chooser option at this point is actually the maximum of the call or the put, because depending on the underlying price, we're going to optimize for a call or put. And then that means having selected what we want that to be, we can exercise here at the strike price on T2. So A first concept about a chooser option is it can be synthesized with a package. We can simulate it. It's going to be equivalent to a call option with strike of K and maturity T2 plus approximately a little bit less than one put option with a strike of approximately K, a little bit less than K, and maturity T1. So we have a long-term call option plus a short-term put option. That package, see, we have an illustration of a package, together simulates our chooser option. And I think, in fact, this informs the pricing model. And then the second concept about the chooser is that we can compare it to a straddle, not exactly the same. Recall a straddle is a combination long call plus long put. See, I called that a combination, not an exotic, because a straddle just combines some standard call and put option. They're similar in the sense that both are long volatility, and they are both unsure of the direction. But the chooser is more confident that the direction will be revealed within a certain time frame and is willing to commit to when that decision will be made. As a result, the investor should pay less for the chooser. Both long volatility and both are not making a directional bet. So notice this is a case of non-directional bet, but the chooser is going to commit to a time frame and pay less. So the barrier options are interesting because as part of the feature of the barrier option, in addition to the strike price, we also have the barrier, which Hull denotes with an H. And we can have either a knockout or a knock-in barrier option. So where the barrier is less than the current strike price, we're going to either have a down and out, meaning if the stock price moves down and breaches the barrier, our option is going to be knocked out of existence, or we could be knocked into existence. On the other hand, the barrier can be set above the current stock price, and that means either we're going to have an up and out or up and in. Either our option is going to be knocked out of existence or it doesn't currently exist and has the possibility to be knocked in. So the key feature here is the barrier, and we can either have a knock-in or a knock option. But please notice that we can have, relative to an option that's otherwise identical, the addition of the barrier should really make the option less valuable because we've added a contingency to its existence. So we can think about that barrier as an overlay that reduces the value of the option. And so we've got the four use cases here: a down and out, where the barrier is set below the stock price. So here I've got my green S sub 0. That indicates the current stock price. And then the barrier is going to be set below. And we have a down and out. And that means that if the stock falls below the barrier, it gets knocked out of existence. So if I sell that barrier option to you and the stock price goes down below the barrier, it gets knocked out, you get nothing. But you'll pay less for that. Due to the barrier. If the stock price never breaches the barrier here, then it's not going to be knocked out, and you're going to have your call or put option just as you normally would. And then the barrier set below the stock price can also be a down and in, so it's not going to start in existence, meaning that if the stock price just meanders here above the barrier and finishes above the barrier, and you bought this down and in from me, then you will not get to exercise anything, you'll get no payoff. And if the stock price drops down below the barrier, then it gets knocked into existence, then you get to exercise it. Similarly, or on the other hand, if the barrier is set above the stock price, we can have two different kinds here, an up and out. So if the stock meanders above the barrier, it gets knocked out of existence and with no payoff. And we can have an up and in, meaning it does not start with a life. And so if it meanders down here, never goes above the barrier, then you as the buyer will never get to exercise it, no payoff. If it does go above the barrier, then you have the regular option. And that barrier, again, is not the strike price. If it gets knocked into existence, The payoff to you in the future is going to be that future intrinsic value based on the difference between the stock price and the strike price, not the barrier. So just keep in mind that this barrier just has to do with the contingency of whether this option gets knocked in or out. The payoff is still a function of the strike price. So concepts in regard to the barrier option. Here's a popular question in Hull. What happens is we increase the frequency with which we observe the asset price. Well, that, if we think about it, right, that's the observation of the asset price is what determines whether the barrier option gets knocked in or out. So as we increase the frequency, the value of a knockout option ought to go down, but the value of a knock-in option ought to go up, because we're making it more and more likely that we capture that moment when the stock price has gone above the breached the barrier and the option gets knocked in. So it really depends on whether it's a knock-in or knock-out. The value of a regular call can be synthesized as a combination of the value of a down and in call and the value of a down and out call. Also, an interesting barrier concept is that the vega can be negative. Our binary option has a discontinuous payoff. If we think about our standard vanilla call option, when we exercise, the payoff is going to be larger as the stock price goes higher. We're going to get the payoff as stock price minus the exercise price. But in a binary option, there's really only two outcomes. As long as the stock price or asset price is above the strike price, then there is a payoff. We're going to get cash or nothing. Or we could get asset or nothing, the two flavors there. So it's not the intrinsic value, but rather it's the cash or asset or nothing. That means that the value of the cash or nothing option actually has a really elegant solution. So Q here is the payoff in the event that there is a payoff. And notice it's discounted here. So that is really time value of money discounting at the risk-free rate, multiplied by the standard normal cumulative distribution of D2. Now, N of D2, this should look familiar. This is an element in that Black-Scholes-Merton option pricing model. And N of D2 in particular is the probability that the option will be exercised in the risk-neutral world. So notice we really have here sort of an elegant expression of a weighted expected outcome. Here's the payoff discounted to today, multiplied by the probability that there will be an exercise, N of D2. So binary, in terms of binary option, the concepts are the value of our call, cash or nothing binary call is given by this, in the same way that the value of the cash or nothing put is also given by using its equivalent risk neutral probability of exercise. We can synthesize a regular European call option, or we can decompose it into two binary options. A regular call option is going to be the same, equivalent to a long position in an asset or nothing call plus a short position in a call or nothing, in a cash or nothing call, where the cash payoff is the strike price. Similarly, a regular European put option and can be synthesized by a long position in a cash or nothing put plus a short position in an asset or nothing put. A binary option resembles, but is not the same as a bull spread. So here's that bull spread. For example, we could have a binary call option that pays $5 with a strike price of $35. So if the stock rises above $35, it pays off the $5. And we might compare that to a bull spread, long a call option with strike at 30, plus short a call option, strike at 35. So there we've got a bull spread, long a call, short a call with a higher strike price. So that notice The similarity here is that if the stock price finishes above $35, notice the payoff is identical. The payoff of a bull spread here in the upside scenario, as indicated here by the flat red line on the bull spread, is a constant, which is also the case with a binary option. So that binary option here on the upside behaves just like a bull spread. They're a little different here in the interim volatility in just a range-bound behavior. 30 to 35, our bull spread will have some payoff, but our binary won't. So look-back options are interesting because we have a few permutations here. But just to illustrate here, I've updated here my stylized example here. And let's just assume that we have a simple stock that just starts at 10, jumps to 13, falls down to 7, and goes up to 11. And now we can have a floating look-back call. And the payoff there is going to be the final asset price minus the minimum price. So the final asset price is the same as a regular call. The difference with the floating look back is look how opportunistic it is. It gets to go back and cherry pick the minimum price. So in our example, a floating look back call purchased here, and here's the path, finishing here, would have a payoff of $11 minus, it gets to look back and find the lowest price. It's using, instead of a fixed strike price, it's using the minimum price in the path. So our floating look back call has a payoff here of 11 final minus minimum 7 equals 4. The other variation here is a fixed look back call. So that uses the maximum price during the path. That's the opportunistic portion minus a fixed strike. So you see here the difference here. The floating look back call does not have a strike price. The fixed look back, per the name, does. So what would happen in our case here? Floating look back call, it would look back, find the maximum price of 13 and subtract the strike. And I'm just going to assume the strike was set here at the beginning at 10. So in that case, we'd have a payoff of 3. And now let's just take the same path price. I thought this would be helpful, and look at it in terms of the floating look back put. And so now we take the maximum price minus the final asset price. So here we look back, in the case of the floating look back put, to the 13 and subtract the final of 11, and we get a payoff of 2. If, on the other hand, we used a fixed look back put payoff where the strike set here at inception to $10 and we end up here, we would take the strike of 10 and we would look back to the minimum asset price of 7. So the fixed look back put, assuming a strike of 10, would have a payoff of 3. Look-back option concepts. As we increase the observation frequency, a floating look-back becomes more valuable. I hope that makes intuitive sense. If we go back to the call here, if we have a floating look-back call, it's going to be the final of 11 minus the minimum price. The more, as we increase the number of the number of observations that we look, we're increasing the chance that we get to pick an even lower value. If you think about, if you purchased this option or were granted this option, you would enjoy a higher frequency of observations here, making this option more valuable. Also notice the intrinsic value of the floating look-back option can never be negative. And really, in one of my texts, they argue that it's not, for this reason, the floating look-back option isn't really an option, isn't really a true option. The shout option is a European option, but the holder can shout at one point. So here we have a purchase or grant of the option at time 0 as usual, and the stock price is evolving. So maybe the stock goes up and you feel like, as the owner, the stock is really high today. I want to take advantage of this, but I want to hold on to the option. You get to shout then and lock in the intrinsic value. So if the stock then drops down here at the finish, at the expiration, with the shout option, you're going to get the higher of the two. So here's the regular. That's typical of the option. At expiration here, you're going to have the intrinsic value. That's what you'd have with a normal standard option. But you also get to compare it to that time that you shouted. If that's higher, you get that payoff. So in other words, at the shout, you get to lock in this intrinsic value. That's going to be the minimum payoff. If that stock keeps going higher up to here, then you're going to get the higher payoff at the end anyway. So you get to lock in a little bit of an insurance bet there. But of course, you're going to pay for that with a higher premium. Now, in the case of the Asian option here, we have an average price call payoff and an average price put. So here, the difference is that instead of a final stock price minus a final strike price, we're going to use an average. So the Asian option is much smoother here. Stock price starts here. We purchase the Asian option. Stock price goes up here to expiration. We exercise. Then we're taking the average of that price during the life of the option and subtracting the strike price from that. The average price put payoff is similar. It's just like a standard option, strike price minus stock price, but instead of final, we're taking the average. So no, it probably makes a lot of sense that this average is going to evolve much more gradually than the final stock price. So there's a much smoother payoff. And if you think about holding this option as we approach expiration, the closer we get here, the more you're going to know your payoff, because it's an average here of the life that's behind you already. As we get closer here, there's really going to be very little volatility here in that final payoff. We can also, just like that look back had a variation here, we can also have an average strike call and put. In this case, with the average strike call payoff, we are going to use the stock at expiration, but instead of a fixed strike, we're going to use the average price over the life of the option. So this option also does not really have a fixed strike price. It's going to be informed by the path. And so these Asian options are what we would call path dependent. So Asian option concepts. Well, in contrast to the barrier options, it's much easier to delta hedge the Asian options because the payoff becomes more certain as time passes, and the delta always approaches zero as the maturity date is approached. So I think that's interesting. As we approach maturity, the delta approaches zero. The volatility of an average of options is always smaller, so the Asian option is always less expensive than its standard option analog. And as I said before, sometimes you've seen these on financial certification exams. This fact that the look-back option and the Asian option are both examples of path-dependent options. Their value is dependent on the path evolution to get them there, as opposed to, if you think about just a standard call option here, it really wouldn't matter what happened right here in the middle. Their payoff here would be right at the end, final stock minus that fixed strike price. But that's not the case with the Asian and the look back. Their value is informed by the path that gets you to expiration, so they are path dependent. An exchange option, instead of paying a fixed strike price, it pays an asset worth U, that's the exercise price, in order to buy or exchange an asset worth V. And then Hull does go into, or does really show the variation on Black-Scholes that can be used to price the exchange option, the McGraw, much beyond testability in the FRM. Rainbow options are options involving two or more risky assets. Basket options, their payoff depends on a value of a basket of options. We have a volatility swap, which is an agreement to exchange the realized volatility of an asset for a pre-specified volatility, or that's the volatility strike. And just as variance is the square volatility, we can have a variance swap, an agreement to exchange the realized variance for a pre-specified variance. Hull says that variance swaps are easier to value because the variance rate can be replicated using a portfolio of puts and calls. And then finally, the basic premise of static option replication is that we can search for a portfolio of actively traded options that approximately replicates the exotic option, and we can hedge the exotic option by shorting this replicating portfolio. And that concludes video 5A. I'll look forward to sharing contents from 5B next. Thank you.